Drake has $73,000 sitting in his checking account. He sleeps soundly at night, knowing it's in a bank. It's safe. The FDIC covers it. Daniel also has money in a bank. But he knows something Drake doesn't, and it could make the difference between getting all your money back or only some of it. The FDIC was created to protect your deposits, but most Americans have no idea how it actually works. And what you don't know could cost you. Here's the full picture. The Federal Deposit Insurance Corporation, the FDIC, is a U.S. government agency created in 1933 after the Great Depression wiped out thousands of banks and millions of people's savings. Its job is simple. If your bank fails, the FDIC makes sure you get your money back. And it works. Since the FDIC was created, not a single depositor has lost a penny of insured deposits. Not during the 2008 financial crisis. Not during COVID, not ever. But here's the critical word: insured. The FDIC doesn't cover everything automatically, no matter how much you have. It covers up to a specific limit, and most people don't understand how that limit works. The standard FDIC limit is $250,000 per depositor, per insured bank, per ownership category. There are 3 variables there, and all 3 matter. Let's break this down. Rule 1. Per depositor. The limit is tied to you, not your account. So if you have a checking account with $50,000, a savings account with $100,000, and a CD with $150,000, all at the same bank, the total is $300,000. But you're still just one depositor, and $250,000 is the limit. $50,000 of that is not insured. But I have 3 separate accounts. Doesn't that count as 3 separate limits? No. Same bank, same ownership type, it's still one limit. Rule 2, per insured bank. If you spread your money across multiple banks, you get a fresh $250,000 limit at each one. Chase and Bank of America are separate institutions. 2 separate limits. My savings is split between 2 FDIC-insured banks. Under $250 at each. Fully covered. Rule 3, and this is the one most people miss, per ownership category. The FDIC has different ownership categories, and each gets its own $250 limit at the same bank. The main ones: single accounts, joint accounts, certain retirement accounts like IRAs, and revocable trust accounts. So here's what that means in practice. If you have $250,000 in a single individual account and $250,000 in an IRA, both at the same bank, you have $500,000 fully insured, because they're in different ownership categories. A joint account between you and your spouse gets its own $250 per co-owner, so a joint account can be insured up to $500,000 at one bank. Drake has $280,000 at one bank, all in a single individual checking account. I'm fine. The FDIC covers bank deposits. He's right that the FDIC covers bank deposits. He's wrong about being fine. $250 is covered. $30,000 is not. If his bank were to fail tomorrow, Drake would get $250,000 back from the FDIC. The other $30,000 would go into a claims process. He might get some back. He might not. And it would take time. Wait, I didn't know there was a limit. Most people don't. And this is exactly why it matters. So what actually changed with the FDIC in 2026? 2 things worth knowing. First, the FDIC adjusted its regulatory thresholds for inflation. Some of the internal rules about how banks are classified and assessed were updated. This doesn't change your $250,000 coverage limit. That hasn't moved, but it does affect how banks are categorized and what fees they pay. Second, the FDIC finalized changes to its Part 328 rule, the rule about how banks must display the FDIC sign on digital banking platforms. Banks have until April 2027 to comply. This matters because it changes how you verify a bank is actually FDIC insured when banking online. Before I deposit anywhere new, I check the FDIC Bank Finder at fdic.gov. 30 seconds. Confirms the bank is insured. Done. Your coverage limit is still $250 per ownership category per bank. What changed is administrative, but knowing your coverage structure matters now more than ever. Here's how to make sure you're fully covered, even if you have more than $250,000. Strategy 1. use multiple banks. If you have 400,000, keep 250 at Bank A and 150 at Bank B, both fully insured. Strategy 2. Use different ownership categories at the same bank. Individual plus IRA gives you 500,000 at one institution. Add a joint account with your spouse, and you can push that even further. Strategy 3. Use the FDIC online tool. Go to fdic.gov and use the Electronic Deposit Insurance Estimator, the EDIE tool. You plug in your account types and balances, and it tells you exactly how much is covered and how much isn't. I ran the EDIE tool last month. Took 5 minutes. Everything's covered. Peace of mind. Strategy 4. For very large amounts, look into CDARs or intra-FI network deposits, services that spread large deposits across multiple insured banks automatically, keeping everything under the 250 limit at each. Here's your FDIC checklist. 1. Know your limit. 250,000 per depositor, per bank, per ownership category, not per account, per category. 2. Spread large balances across multiple banks or multiple ownership categories at the same bank. 3. Verify any bank you use is FDIC insured at fdi.gov. Takes 30 seconds. 4. Use the EDIE tool at fdic.gov to calculate your exact coverage if you're unsure. 5. IRAs, joint accounts, and trust accounts each get their own limit. Structure your accounts accordingly. I need to move $30,000. I moved mine 6 months ago. Already done. This video is for educational purposes only and is not personalized financial advice. If this helped you, subscribe. We post a new personal finance video every single day. Next, watch our video on credit score changes happening in July 2026. New rules are already affecting millions of Americans, and it pairs perfectly with what you just learned.